Getting some ISMs and JOLTS. Let's get back to Rick Santelli. Rick.
Yes, and watch markets. They give you pretty good clues. See rates going down. We'll get to why in a moment. Construction spending, well, it was up 0.4, exactly as expected, although that is the weakest level since April. JOLTS, job openings and labor turnover, 9,553,000, better than expected. However, last month had a big revision from 9,610,000 to under 9,500,000, which means that this is now the strongest number since May. It would have been just in line with last month, but the downgrade was so large. That's where the comp even moves further back. Now, here's where the weakness seems to be showing up. The ISMs, okay? If you look at 46.7 on the manufacturing, 46.7 is the weakest since July, and it is now the 12th sub 50 in a row. If you look at prices paid, expected to be 45, comes in at 45.1. 45.1 actually is the highest, well, only since August when it was 48.4, 6 in a row under 50. But in this case, that's a good thing. We want it to be under 50. We want prices paid to moderate if you're looking for inflation metrics, of course, to ease back. On the employment front, considering we had ADP on Friday, we get the big jobs report. 46.8, well below the 50 and change expected. 46.8 actually is the weakest number going back to July when it was 44.4. And this represents, of course, a fallback under 50. Last month was 51.2. And finally, on the new orders front, expecting a number just under 50. It is well under 50, 45.5, 45.5, and that is the weakest going back to June. So there's where your impetus is for some of the buying in treasuries on those last ISM manufacturing price paid deployment and new orders. And we want to pay particularly close attention to the 479 to 480 in 10s. That has defined the lower end of this range since on the 23rd of October we had that intraday violation of 5%. Sarah, back to you.